Welcome to the deep dive. We're jumping straight into the financials today, looking at Samsara's Q2 FY26 results. Just out.
And they look pretty strong right off the bat.
Yeah, really strong. They beat expectations, gave some solid guidance. So let's unpack it. Okay, first up, the headline numbers. This is for Q2, ended August 2nd. Total revenue, $391.5 million. That's up 30% year over year.
Wow, 30%. And analysts were looking for what, around $372 million?
Exactly, so a decent beat there. And their ARR, annual recurring revenue.
Always a key metric for these SaaS companies.
Right, that hit $1.640 billion, also up 30% year over year.
Okay, so consistent growth across the board. Did that beat estimates too?
It did. Consensus was $1.624 billion, and then earnings per share adjusted EPS.
Let me guess, another beat.
You got it. So a triple beat then. Revenue, ARR, and EPS.
Okay, so a triple beat then. Revenue, ARR, and EPS. That's quite the statement.
Definitely sends a strong signal.
It really does. And you know, it's interesting how the CEO, Sanjit Biswas, talked about it.
What did he say?
He called it another strong quarter of durable and efficient growth. Emphasis on durable and efficient.
Right, not just growth at any cost.
Exactly, especially hitting that $1.6 billion in ARR. He also explicitly linked it to the rise of the AI-driven economy.
Interesting. How so?
Well, he basically said this trend is amplifying demand for their platform, their connected operations platform.
So they see themselves as a key player in that whole AI infrastructure build-out.
That seems to be the message, that their tech is benefiting directly.
Okay, so that AI connection is interesting. But lots of companies mention AI. Can you maybe quickly break down what their connected operations platform actually is for anyone maybe less familiar? What makes it tick?
Sure, good question. Think of it like a central hub for businesses with lots of physical assets. Vehicles, equipment, buildings.
Like logistics, construction, that sort of thing.
Exactly. Their platform connects all these physical things using sensors and IOT devices, pulls in real-time data, and then uses software, including AI, to help companies manage everything better. Safety, efficiency, maintenance, you name it. It's about bringing digital smarts to, the physical world of operations.
Gotcha. So the AI isn't just a buzzword. It's fed by their own unique data from these connected assets.
Precisely. It's proprietary data you can't get elsewhere. That's what fuels their AI applications for things like route optimization or predictive maintenance. It's pretty core to their model.
All right, that makes sense.
Okay.
So digging deeper then, how did they get this growth? The numbers look great, but what's driving it? It seems like it's about bigger customers, right?
Yeah, that's a huge part of the story. Their focus on larger enterprises and that whole land and expand strategy.
So they get in the door, then sell more over time.
Exactly. And the numbers back it up. They now have 2,771 customers spending over $100,000 a year in ARR.
Wow, 2,771. What was that number a year ago?
It was 2,120, so a pretty significant jump.
Definitely. And those bigger customers, they must account for a lot of the revenue.
Oh, absolutely. Those $100 K plus ARR customers, they generate about $1 billion in ARR combined.
$1 billion, just from that group.
Yep. That's up 35% year over year, and it's 59%, almost 60% of Samsara's total ARR.
Okay, so they're really leaning on these larger deals.
And it goes even bigger. Get this. Customers spending over $1 million a year.
$1 million accounts.
Yeah. They contributed more than 20% of total ARR, and they added 17 new ones just this quarter, a record add.
17 new $1 million plus customers in one quarter. That's substantial.
It really is. It shows they can scale with the biggest, most complex operations out there.
And the source mentioned some big names they're working with.
It did. They highlighted partnerships with organizations like Alaska Airlines.
Big airline.
Yeah, fifth largest in the U.S. Also, SRM Concrete, the largest ready-mix concrete provider. Think heavy industry.
Right. Very different businesses.
Totally. And even Bonnie Plants, deploying 15,000 asset tags. Plus, a UK subsidiary of a major global retailer signing up for multiple products right from the start. Safety, telematics, workflows.
So it's not just one product. They're getting deep integrations.
That seems to be the key. They land, often with multiple products, and then they expand.
And they're still adding core customers too, right? Not just the huge ones.
Correct. They added over 1,000 core customers. That's those spending over $10 K ARR for the fourth time in 5 quarters. So still filling the funnel.
Okay, consistent pipeline build.
And here's a telling detail. 9 of their top 10 new customers started with 2 or more products. 8 started with 3 or more.
So new clients are immediately seeing the value in multiple parts of the platform.
Seems like it. They're not just dipping a toe in. And for existing customers, 15 of their top 25 biggest customers expanded their usage in Q2.
Expanding, meaning buying more services or deploying to more assets?
Both, usually. And again, 10 of the top 10 expansions involved multiple products. It shows that stickiness.
Right. And that ties into their net retention rate, doesn't it? They hit their target there.
They did, around 115% dollar-based net retention for those core customers.
Can you quickly unpack what that 115% actually means? Why is that number important?
Sure. It basically means, on average, the customers they had a year ago are spending 15% more with them today.
Okay. So it includes upsells and expansion minus any churn.
Exactly. Anything over 100% means existing customers are growing their spend. And 115% is generally considered very strong for a SaaS business. It shows customers are happy and finding more value over time.
Got it. That makes sense.
And you asked why these big companies are adopting so many products. The shareholder letter really emphasized this move away from fragmented systems.
Right. Companies want one place to see everything.
Precisely. They want a single system of record for their physical operations, and Samsara is positioning itself to be that system.
And it's working not just in the U.S.
Apparently not. International markets brought in 15% of the net new ACV, the annual contract value.
Okay, so good global traction.
Yeah, and diverse industries, too. Construction was the top contributor to new ACV for the 8th quarter running, so broad appeal.
Okay, so growth is strong, customer acquisition and expansion looks solid. What about the efficiency side? You mentioned the CEO highlighted that.
Right. This is another really impressive part of the report. They showed significant improvements in profitability and efficiency.
How so?
Well, their non-GAAP gross margin ticked up slightly to 78%. That's pretty healthy.
Okay, 78%. Good.
But the big jump was in non-GAAP operating margin. It hit 15%.
15%. What was it before?
It was only 6% a year ago, so that's a 9 percentage point improvement year over year.
Wow, that's a huge leap in operating efficiency.
It really is. And their adjusted free cash flow margin also saw a big jump, up 7 points to 11%.
Okay, these are non-GAAP numbers. Just quickly, why do companies focus on these adjusted figures?
Good question. Basically, non-GAAP figures remove certain expenses that aren't directly tied to the core day-to-day operations, like stock-based compensation or maybe some one-off charges.
So it gives a clearer view of the underlying business profitability.
Exactly. It's meant to show how the core operations are performing in terms of profit and cash generation, kind of smoothing out some noise.
Got it. And these margin improvements, they weren't just small tweaks then.
Not at all. The report suggests it's coming from leverage across the board: cost of goods, sales and marketing, R&D, G&A. They're getting more efficient everywhere as they scale.
So making more money and getting better at keeping it.
That's the idea. It's a sign of maturing operations and strong execution. Really positive for long-term health.
But sometimes, driving efficiency that hard can impact innovation or maybe customer support. Any sense of how they're balancing that? Are they sacrificing growth for margin?
That's a fair point to raise. Based on the report, it doesn't seem like they're sacrificing innovation. They talk about an unprecedented pace of AI development.
Right.
And the high retention and expansion rates we talked about. Those wouldn't likely hold up if customer satisfaction or product quality were slipping significantly.
Sure.
So it suggests they're finding ways to be more efficient, maybe through better processes or leveraging their tech without hurting the core growth engine or the customer experience. It's a balance, but these results suggest they're managing it well right now.
Okay, that makes sense. So looking ahead then, what did they guide for? What's the outlook?
All right, so for Q3, the current quarter, they're projecting revenue between $398 and $400 million.
Which is about, 24% growth year over year?
Yeah, around 24%, and they expect that 15% non-GAAP operating margin to continue. EPS guidance is $0.11 to 12 cents.
And how does that revenue guidance compare to what analysts were thinking for Q3?
It's actually a little bit above consensus estimates, another sign of confidence.
Okay. And for the full year, fiscal 2026?
They raised their full-year guidance. They now expect total revenue between $1.574 billion and $1.578 billion.
Which is about 26% growth for the full year.
Right. And they're guiding for a 15% non-GAAP operating margin for the full year as well, with EPS between $0.45 and $0.47.
So they raised the full year outlook. By how much?
It's about a 2% raise at the midpoint compared to their previous guidance, moving from around $1.55 billion up to over $1.57 billion.
So even with all the talk about economic uncertainty out there, they're feeling confident enough to raise their forecast.
It certainly seems that way. They also mentioned expecting net new ARR in Q3 and Q4 to be at least in line with last year, which sounds like a maybe slightly cautious but confident stance. They're not projecting runaway acceleration, but solid continued growth.
It feels like they're building a track record of beating and raising, doesn't it?
They definitely are. Consistency is key for investors.
So obviously management is optimistic, but what are the potential bumps in the road? Are there big risks we should keep in mind?
Well, for any company in this space, competition is always there. The IoT and operations tech market is getting crowded.
All right.
And maintaining that high growth and those retention rates, especially with huge enterprise clients, demands constant innovation and top-notch support. That's an ongoing challenge.
And balancing growth with profitability, like we discussed.
Exactly. But their success so far, especially the land and expand wins and their focus on critical workflows, suggests they've built a pretty sticky platform. The raised guidance implies they feel pretty good about managing those risks relative to the opportunity.
Okay, so bringing it all together,
Yeah.
why are they so confident? What's the secret sauce for this durable and efficient growth they keep talking about?
Well, they laid out a few key strategic pillars in the shareholder letter. First, and this seems really crucial, is what they call a unique defensible data advantage.
Right, the data from their sensors.
Exactly. They're processing around 20 trillion data points a year now.
20 trillion, that's hard to even picture.
It's massive and growing over 50% year over year. And crucially, it's proprietary IoT data from real-world operations, stuff you just can't get anywhere else.
And that data feeds their AI.
Precisely. That's the fuel. It lets them innovate rapidly, release new AI-powered features, make their products smarter, which then drives more customer usage and value. It's that flywheel.
Okay, data and AI. What else?
Second, they feel they're really well aligned with the long-term growth in physical infrastructure.
How so?
Their business scales with physical assets, more trucks, more equipment, more facilities, not just employee headcount. So as industries involved in logistics, construction, energy, transportation modernize and grow,
Samsara grows with them.
that's the idea. They're positioned to benefit from big secular trends like the AI infrastructure build-out you mentioned, or just the general digitization of these core physical industries.
Makes sense. And the third pillar.
It's about delivering a differentiated value proposition in mission-critical workflows, basically providing clear, fast, tangible ROI.
So less nice to have, more need to have.
Exactly.
Duh.
Things like improving safety, which lowers insurance costs, reducing fuel usage through better routing, getting more work out of expensive assets, helping exonerate drivers in accidents with video evidence.
Real bottom line impact.
Right. Things that directly save customers money or significantly improve their operations. That makes the platform essential, not discretionary, which drives those high retention and expansion numbers we saw.
Wow. Okay, so strong numbers, impressive customer wins, better efficiency, confident guidance, all built on this foundation of unique data, AI, and clear ROI.
That sums it up pretty well. A very solid quarter, and the narrative seems quite compelling.
It really does. What an insightful deep dive into Samsara's Q2.
So thinking about all this, the sheer amount of data coming from physical operations, the AI being applied, it really makes you wonder, doesn't it?
Under what?
Just how much further this digitization of the physical world can go. We talk about the digital economy, but maybe the biggest transformations are still ahead in these industries we used to think of as purely, analog. What does that unlock next?